The traditional financial formula you were always told guarantees a safe and secure retirement has fatal cracks in its foundation. For decades, financial planners swore by the 4% rule. You build a nest egg and you withdraw 4% every year to live on. That math worked in an era when bonds paid massive, steady coupons and stock dividends were high enough to actually cover your living expenses. Today, that math is failing. The S&P 500 currently pays a dividend yield of around 1.5%. This chart shows what happens when applied to a standard retirement goal. If you want $60,000 a year from a $600,000 portfolio, a 1.5% index yield only produces $9,000. You are short by over $50,000 a year. To survive this massive shortfall, you eventually have to sell off your own shares just to make up the difference. If you are forced to sell while the market is dropping, those shares are gone forever, and your account drains exponentially faster. Relying on traditional asset classes to fund modern retirement creates a mathematical trap. Without a new source of yield, you are eventually forced to consume the very principal you need to survive. To fix the income gap, the strategy shifts from passive ownership to active participation in the options market. By selling the potential for future price gains in exchange for immediate cash, you collect income by selling the market's natural anxiety to traders. These Generation 2.0 option funds act like an insurance company for the stock market. They collect upfront payments from traders who are willing to pay a premium to protect themselves against big market swings. This graph shows the volatility risk premium. The top line is implied volatility, the amount of fear traders have about the future. The bottom line is realized volatility, what actually happens. The space in between is the premium, which is consistently overpriced by a fearful market. Capturing this premium converts that gap into double-digit monthly yields, independent of traditional corporate dividend payouts. By substituting the volatility risk of option writing for the credit risk of high-yield bonds, you can engineer a 10% income stream without ever having to liquidate a single share of your principal. To construct this, we use a barbell strategy, splitting capital between two different types of funds. The first half is the growth engine, built on major indexes like the NASDAQ 100. Earlier covered call funds had a structural flaw. They sold options against 100% of their holdings. If the market went on a massive bull run, the fund's gains were capped, causing the value of the account to stagnate or even drop over time. Modern funds solve this with a dynamic overwrite. Rather than capping everything, the manager dynamically adjusts the percentage of the portfolio covered by options, shifting between 25 and 75% based on current market volatility. When the market is calm and trending upward, they lower the hedge. This allows most of the portfolio to run completely uncapped, capturing the market's natural growth. This flexibility provides the fuel to refill the portfolio's net asset value. It ensures your initial investment grows during rallies, rather than being left behind. But that growth engine has a vulnerability. Because of how those options are structured, the IRS often taxes those distributions as ordinary income, which can remove up to a third of your spendable yield in a high tax bracket. That leads to the second half of the barbell, the tax-optimized yield engine. These are specialized funds designed to protect your cash flow from the tax code. These funds utilize a call spread. Instead of selling an option that caps your upside completely, they sell a ceiling to generate income, but simultaneously buy a higher-priced call, effectively installing a skylight to capture gains during extreme market surges. They also deploy a specific part of the tax code known as Section 1256. Because they use index options, the income is split into two buckets. 60% is taxed at the lower long-term capital gains rate and 40% as short-term. By harvesting losses against this split, managers can reclassify a large portion of your distribution as a tax-deferred return of capital. You receive the cash today, but lower your effective tax rate. Optimizing your tax structure is as vital as generating the yield. A high gross yield is worthless if you are silently burning your own exhaust, paying ordinary income taxes on every check. However, running a 10% withdrawal rate carries a mechanical risk. If the market enters a prolonged bear market, this system can turn against you. This tracks destructive return of capital. If the fund pays out more cash than it earns, your principal shrinks. This triggers sequence of returns risk. If your $600,000 account drops to $400,000, withdrawing $5,000 monthly requires exponentially higher yields, accelerating the decline. To survive this, you must follow one rule. During a market crash, accept a variable, lower nominal payout to protect the underlying principal. Conversely, when massive market panics cause yields to spike to 14%, you must reinvest that surplus back into the account to buffer your shares. This strategy is a complex mechanism depending on active participation in volatility and the tax code. By respecting these mechanics, moving past outdated withdrawal rules, you build a resilient portfolio that generates cash every single month.